There's a WhatsApp group in Dubai right now where precious metal dealers are doing something they haven't done in 15 years. They're apologizing to clients. Not for delays, not for paperwork, for having nothing to sell. Silver bars that cost $32 an ounce on the global market are selling for $135 in physical shops across the Emirates. That's not a premium. That's a different asset class. And here's what makes this genuinely strange. The price charts you're looking at online, the ones that say silver is trading calmly around $32, they're not wrong. They're just measuring something else entirely, something that doesn't exist in the real world anymore. We need to talk about what happens when paper and metal stop being the same thing. 3 weeks ago, a refinery manager in Switzerland sent an email that didn't make headlines. It should have. He told his largest distributors that delivery times for 1 kilogram silver bars had moved from 2 weeks to 16 weeks. Not because of production problems, because there was no silver to refine. Dubai is the canary. It's always the canary. The city sits at the crossroads of East and West, and when wealthy Indians, Chinese, and Middle Eastern buyers want physical precious metals, they don't call New York. They call Dubai. The Emirate imports roughly 200 tons of silver every month during normal conditions. In the last 30 days, imports collapsed by 60%, while walk-in demand tripled. Do that math. It doesn't work. Here's what the average buyer sees when they walk into a gold souk right now. Empty display cases where silver bars used to be stacked, handwritten signs saying pre-order only, and premiums that would make a scalper blush. A kilogram bar with a melt value of around $1,000 is being quoted at over $4,000. Some shops have stopped quoting prices entirely. They just take your number and call you if something comes in. This isn't a Dubai problem, it's a preview. Reports from Germany, India, Singapore, and parts of the United States are showing the same pattern. Physical silver is being treated like concert tickets to a show that's already sold out. Meanwhile, the futures market in New York and London says everything is fine. You can buy 1,000 ounces of silver right now with a few clicks. Delivery in 3 months. Maybe. That word is doing a lot of work. Let's rewind and explain why there are two prices for the same metal. Most people think the silver market works like a farmer's market. Miners dig it up, refiners turn it into bars, dealers sell it to you. Simple, physical. That's not how it works. The global silver price you see quoted everywhere is set by the futures market. Futures are contracts, promises to deliver silver at a future date. They trade electronically, billions of dollars a day, on exchanges in New York, London, and Shanghai. These contracts are the price, not the metal, the contract. Here's the trick. Most futures contracts never result in actual delivery. Traders buy and sell the contracts themselves, closing positions before delivery is required. It's a paper market. Roughly 95% of silver futures trading has nothing to do with physical metal changing hands. It's speculation, hedging, price discovery. It works until it doesn't. Now add leverage. In the futures market, you don't need $100,000 to control $100,000 of silver. You need a fraction of that, maybe 10 or 15%, called margin. This amplifies liquidity. It also amplifies risk. The physical market is the opposite. You pay full price up front, you take delivery, you store it. It's slow, expensive, and clunky, but it's real. These two markets, paper and physical, are supposed to stay connected through arbitrage. If paper silver gets too cheap compared to physical, traders buy paper contracts, take delivery, and sell the metal for profit. If physical gets too cheap, they buy metal and sell futures. This mechanism keeps the prices aligned, except when there's no metal to deliver. Here's what's happening now, step by step. Industrial demand for silver has been climbing for 3 years. Solar panels, electric vehicles, electronics, all require significant amounts of silver. Global solar installations alone consumed roughly 150 million ounces of silver last year. That number is expected to grow by 20% annually. At the same time, mine production is flat. New silver deposits are rare. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just make more when demand spikes. This creates a deficit. The world is consuming more silver than it's producing. The gap has been filled by above-ground stockpiles, recycled silver, and inventory held by exchanges. That inventory is now being drained. Registered silver in COMEX warehouses, the benchmark for deliverable supply in the United States, has dropped by 40% in 18 months. It's not gone, but it's not liquid either. Much of it is spoken for, held by ETFs or long-term holders. Now add a new variable, retail demand. In 2024, retail investment in physical silver bars and coins hit a 10-year high. Not because of inflation fears or currency collapse theories, because people noticed the price hadn't moved while everything else did. Silver is up modestly over 5 years while gold doubled. It looked cheap, so they bought. This wasn't a frenzy, it was steady, persistent buying that kept pressure on the physical market month after month. Mints started rationing, dealers started pre-selling, lead times stretched. Dubai is where this pressure turned into a rupture. When wealthy buyers in the Gulf decide they want physical silver, they want it now, not in 16 weeks. They'll pay premiums to skip the line. $50 over spot became 70. 70 became $100. In some cases, premiums have hit $110 per ounce on a metal trading at 32. The arbitrage opportunity is obvious. Buy paper silver at 32, take delivery, sell it in Dubai for 135. Instant profit. Except you can't take delivery, not quickly, not in size. The metal isn't there. This exposes something uncomfortable about the modern commodity system. Paper markets exist because they're efficient. They allow price discovery, risk management, and liquidity at scales physical markets can't match. But they also allow something else, leverage and promises that exceed reality. The COMEX has rules about how much silver must be held in reserve relative to open contracts. Those rules assume most contracts will be rolled or closed, not delivered. The system is built on the assumption that physical demand will remain predictable and modest. When that assumption breaks, the paper market keeps trading, but the connection to reality weakens. Here's a thought experiment. If everyone holding a silver futures contract right now demanded physical delivery, could the exchange provide it? Technically, yes. There's silver in warehouses, but it would take months, maybe longer, to settle every claim. The logistics of moving, verifying, and delivering thousands of tons of metal don't scale instantly. The market prices as if delivery is frictionless. But friction is the whole story now. What you're seeing in Dubai is that friction becoming a cost, a very expensive cost. Some analysts argue this is manipulation, that paper markets are being used to suppress the true price of silver by creating the illusion of abundant supply. Others say it's just a temporary dislocation, a logistics bottleneck that will resolve once mints and refiners catch up. Both might be right. But that doesn't make the current situation less surreal. You can theoretically buy silver at $32 an ounce, but you can't hold it in your hand for less than 135 in parts of the world. That's not a market. That's two markets pretending to be one. The question isn't whether this premium is sustainable. It's not. Either physical supply catches up, or the paper price moves, or demand collapses. Something has to give, but which thing gives first matters. If mints and refineries ramp up production and the supply shortage eases, premiums fall, life goes on, and this becomes a footnote. That's the optimistic case. It assumes production can scale quickly and that demand stays rational. If physical supply stays tight and more buyers decide they want metal instead of contracts, the premium stays elevated or grows. At some point, the paper price has to acknowledge that disconnect, not because of manipulation or conspiracy, but because arbitrage eventually forces alignment. If you can't actually get silver at the quoted price is fiction. The third option is darker. Demand evaporates because buyers realize they can't access the physical market at reasonable prices and decide the whole thing is not worth it. That would collapse premiums, but also signal a loss of confidence in the commodity itself as a store of value. Right now, we're in a strange middle ground. Silver is functionally unavailable in major hubs, yet the price remains calm on screens. That calm is either the market being rational and forward-looking, pricing and future supply increases, or it's the market being disconnected, trading a derivative of reality rather than reality itself. Dubai's shops aren't worried about the second derivative of silver demand projections. They're worried about having product to sell tomorrow. Here's what this really shows. We've built financial systems that are extraordinarily good at moving information, capital, and risk at the speed of light, but those systems still rest on physical things, metal, oil, grain, and physical things move slowly. They have weight, location, and limits. When the paper layer gets too far ahead of the physical layer, markets bifurcate. You get two prices, two realities, coexisting awkwardly until something snaps them back together. Silver might not matter to you. You might never buy an ounce. But the principle matters everywhere. Housing markets where prices diverge wildly between regions. Food commodities where futures trade calmly while shelves empty. Currency markets where digital dollars and physical cash stop behaving the same. The question isn't whether Dubai's silver premium is justified. The question is what it means when the price on the screen and the price at the counter are so far apart that they're not even pretending to be the same thing anymore. And whether that disconnect is temporary or a preview of how markets behave when trust in delivery becomes more valuable than the contract itself. Right now, somewhere in Dubai, a dealer is telling a customer they can't buy something that officially exists in abundance. That sentence shouldn't make sense, but it does.